Hello, this is Todd Foster, and this is your market wrap for the week ended March 7th, 2025. In today's webcast, we'll talk about whether it's a bear market or is there still a chance of one more rally in the market. I'll go through my reasons why. In the short run, it looks like a low is going to form over the coming days. Fridays might be a little iffy for a bottom, so maybe early next week, and we'll look at that. Bonds are still above long-term support, so that's good, and they're acting normal. Stocks down, bonds up, so that's good, and we own bonds. Commodities, oil hit long-term support in that triangle. It did bounce, so we'll see where that goes. If it breaks down, it's another recession signal. Gold and silver are holding up. Gold is still better than silver. The US dollar has been tanking, but it hasn't been like exploding. Usually a lower dollar is good for risk assets. It hasn't been playing out that way. But it is almost at the 200-day moving average where we can expect a bounce like the markets and Bitcoin. Bitcoin's following the market as well. All this news with the administration is all BS. It's all priced in, so don't get all sucked into that and uber bullish on it. We need to have a risk-on environment. If the S&P and NASDAQ are going to go up again, then Bitcoin's going to go up. It's as simple as that. So let's get into the charts, and we'll show you guys what's going on here. So the first thing here is the S&P 500. So we've had about a 7% drop. These two lines are the 200-day moving average. Remember, this is through years of experience, a lot of times people buy at the 200-day, and you can see there was some buying. 3 days we held above it, which is very normal. People are just programmed to buy the 200-day moving average because it is long-term support. You see here it got close and then it bounced. However, when we get into a big move down, I like this 200 and 250-day, these lines right here, which as you can see are at 5,600. And we're at 56.73. So, I mean, that would be a big down day. It'd be another 2% down day if we get it all today. Or if we end around here, we could have another gap down Monday that gets bought, and then we see a hammer off this general support. You could also see couldn't get past, breakout, test, sort of a test. Now we're fully testing it. The other thing this does is you could see how oversold we are here. We're almost at 30 on the RSI. Look what happened here. Markets bounced. Look what happened here. Markets ripped, and we're right there. The MACD is at negative 75. In August, it's lower than August. And you can see on the top, usually around 75 is where we top. So we're getting very close to a short-term low, but it could get sloppy. We could even undercut this a little bit. Undercut it intraday and then get back above it. But this is really my line in the sand right here. So we're getting close. Now, if we are entering a bear market, I know this sucks. However, let me go forest from the trees and show you what's in store if we have entered a bear market. So you know that we're very early. Remember, we already sold in December. This move here got us, I think it was this drop, gave us a sell signal. So we did raise cash. Now we did put money back to work on this move up here, but net, we're only about 75% invested during this decline, and we own bonds, which have been holding up, and I'll show you that as we get into the bond market. So we're doing okay. Look at what's in store, okay? This is a monthly chart of the S&P. Negative divergence on the new high. You see the MACD hasn't crossed yet, but if it does, it's lights out, okay? This is what happened last time it crossed, and we had the 22 bear market, okay? So not definitive yet, but we're still in early March here. So let's see what this does by the end of March. But as you can see, look at when you zoom out, we're up here, okay? I know it, again, short term stinks, but what we're expecting is at least a drop down is 4,500, which is about a 25% drop. Then we may get a rally and then a bigger drop down to here, which would be a 40% bear market, okay? The other alternative is we go here, and then finally break out. We'll see how that develops. But all I wanted to show you is there's a lot of meat on the bone just to get down to this first low. Whether we bounce around and go up or we bounce and come down, it doesn't matter. This first leg down, we're still very early in the decline. So we need to wait for a bounce. A bounce would be nice here because it would form this topping pattern, the shoulder. This whole thing is ahead. You see the retracement rallies. When we get the bottom, the typical bear market rallies bounce 50 to 65%, meaning they get back 50 to 65% of the losses. So there's the 50-yard line at 58.81, around 5,900, and here's the 62% around 59.50. So it is silly for us to do a single thing here. We're going to let this play out wherever it does, and then we're going to run the retracements, and we're going to watch how that rally unfolds. And then we're going to look at these other things I'm going to show you, which I wrote in the report, to really determine, are we in fact going into a bear market, or was this just a 10% bull market correction down to long-term support, and we're going to hit new highs, okay? But I need to see the bottom, wherever that comes. I need to see the bounce, and then we'll be able to make the next move. But as of this second, for anybody watching this, we're not doing a single thing right now, okay? Until we see this low. So I hope that's clear, because I think last week I was a little unclear. I am bearish. Listen, I've been talking to you guys all last year. Recession this year, recession this year. Maybe this is it, but I'm going to go into some reasons why we still might get that one more high. Remember, several weeks ago, I still thought we could get to 6,400. Let's see how this plays out. So we need more time, and you have to just be a little bit patient. And we don't act emotional. We wait for these things to play out over time. And again, usually markets don't go from here to here in a straight line. That would be barring some major disaster where the stock market wouldn't matter anymore if something like that happened. Okay. Just another thing here for why I think we're hitting. There's the 250 day. There's these lines right here, and you see this channel that we've been in. So this is parallel channel. So we could have just got bounced here, and we're going to go up to new highs again. All right, so we're still kind of looking okay here. All right, on when we look at this channel. Now, the reason why I need to temper my bearishness and kind of watch things a little longer is the yield curve. I told you about this for years. It inverted back here in the summer of 22, so it's almost, what are we, 2.5 years in. This, when it turns red, it means we're inverted. And what that means is short-term rates are above long-term rates. This is usually a very good predictor of recession. However, the sell signal doesn't come when this turns red. It's when it turns gray. And you could see that it turned gray there in, I guess it was December or January. Okay? So it did start to do the gray bars, and that's why maybe we got this beginning sell-off or something like that, okay? So, but I want to zoom in here, and this is all years down here, folks. This is 1980 all the way over here. Down here is 1980. So we're going to zoom in and just look at this, and you can see that we're back to inverted again. Oh, so December, uninverted, January uninverted, and then February it inverted again, and March it's still inverted. When it's still inverted, the markets can still rally, okay? Like they did for the past 2 years, all right? So we've had this red down here, but look what the market did, okay? So if this is going to go red again, then are we going to see one more new high in the market? Now, there is a historical precedent for this, so let me see if I can move this over so my face isn't in the way. Right here. I think you guys can see it here. So this is that yield curve, okay? And this is in the 1970s and in 2000, we can see that these yield curves moved up. However, we're not getting that steepening yet. Actually, this is starting to roll back over again, okay? And there have been 2 periods where that's happened, and actually the markets have gone to new highs. So this is, again, very important that we watch this, and it's all dependent on short-term rate, and the Fed is meeting in 2 weeks, what they do, and also long-term rates, which we know have been falling because long bond has been rallying, okay? So we need to watch these dynamics in the bond market, and we'll be able to kind of assess whether or not, in fact, this is it, this is the end of it, or we're going to see that one more rally. This is another chart I did on the yield curve. It just shows you there's the zero line. So there's the break above, and it started to rip higher. When it starts ripping higher, that's the sell signal. So actually, the market's doing what they did is probably correct. But look what happened here. It dropped back below the zero line, okay? Just like here in 19, and we got another rally in 19, right? So here's a perfect example of it, okay? So we want to see if we get this inversion to come back down to support. And just looking at technicals here, it looks like that is going to happen, meaning that these bars are going to stay red, at least for a few more weeks or a couple months or whatever. Yeah, it looks like a couple more months. And that couple of months could give us one more rally in the markets. So, once this MACD crosses down, usually it needs to come all the way back down. And this has been a pretty big rally. So I'm expecting this yield curve to come back into inversion for several months here, maybe even until May or June, it looks like, maybe May. This is a weekly chart, okay? So again, we're going to have to see. Now, if this starts to turn back up here and rip higher, that would be the sell signal, okay? So when this actually turns back to gray, given the action that we're seeing in the actual stock market itself, that would be the sell signal. The other thing that's holding me back from going all in and on the recession situation at this second is high yield bonds. So these are the junkiest bonds. These companies have to pay the highest interest rates. They need to refinance their debt. It just measures kind of risk appetite of companies, smaller companies usually. Usually what happens is this line here starts to go down, but the pink line keeps going up. We didn't have that. Look at here, we got the HYG went up, and see the pink line went higher. There was no divergence. There was none of this. What we need to see now is actually high yield bonds may move up and then move down, and we need this S&P to start to go to new highs almost. So if this went to new highs and high yield bonds kept falling slowly like this, that would be the signal. And this is very important. This is the riskiest companies in the market. These are companies that have to pay higher interest rates. So right now, I think this high HYG is only like 1% off the highs. So if the junkiest stuff is only 1% off the high, are we gonna go into a recession just yet? Okay. So again, these are the things that are just tempering my bearishness, okay? So that's why we need a little patience as we work through these issues and see continued action in the markets. The other thing is fear and greed. We're at an extreme greed, so this is why we're not doing a single thing. Long-term clients know that when we get into this zone, you don't sell, all right? You wait. Even if it has to go a little lower, you wait. Because what this means is people are bearish. People being bearish means there's almost no one left to sell. When there's no one left to sell, demand comes in and the market goes up. So, and we're seeing this even on some of these other indicators I use here. This is another way to do it with the VIX. But we got into the bottoming zone. Now, do we have to spike a little higher? Maybe. Today this got to 107.9, so it's like intraday right here. I don't think this updates until later today. But we're entering this bottoming zone. Interestingly, this was during Trump tariffs last time too, all that volatility that we got in here, okay? But you can see these spikes here marked bottoms in the S&P down here. Look at that, spike, okay? So again, sediment-wise, could this be the kickoff of the bear? Yeah, that is true, where again, we're getting oversold, we're getting to long-term support, we have a bounce, that relieves this fear, kind of brings it back into here, and then we start tanking again, okay? So that definitely could be the case, but being that we're 7%, 8% off the all-time high, and we're getting fear readings that are equal to some major bear market lows, again, it's just tempering my bearishness or my call for recession. Again, longer term, sometime this year, even if we get that one more rally, we're going into a bear or it's started. But again, we need to take this kind of in a very surgical way. All right, so we did a little bit. Now we wait for the next step, then we wait for the next step, and so forth. Moving on to the dollar. The dollar here has come down down to the 200-day moving average. That's the red line right there. Usually when the dollar is doing this, risk assets go up. It's good for multinational companies, good for international stocks, good for commodities. This time it's not really doing too much, okay? So we are approaching long-term support of that red line, the 200-day, and even kind of getting into here if we come down here, okay? If we come a little lower on the dollar. So we'll see. Dollar going down has been bearish, I guess, for stocks this time, all right? So that's why you got to kind of look at every market individually because they never always match. Typically, and the markets were kind of going up through the dollar going up, all right? So maybe we need to see the dollar bottom in here and start to turn up, and that will give us the S&P low that we're looking for. Moving on to oil, here's this triangle. Long term, folks, is 21, 22, 23, 24. This is COVID lows. Big rally, been going sideways. Still support, 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 support. We're at support and we're a little bit off the lows, okay? If this was to break down, it would be another recession signal. However, it didn't break down yet, okay? So maybe I could put this into the bucket of caution, but not confirming a recession just yet. So that's the oil market. Gold's been holding up, kind of holding by the highs, even with the market down, another percent and something today. It's barely down, but I still think usually when this happens, it's going to need to come in a little bit. But you can see there's a pretty good support here. Again, this could match up to the S&P, where this comes down. The S&P comes down, and then they both go up one more time because although we got very close to our target, that's why we sold. The higher target was around 3,100. I think we got to 2,976. So close, but maybe there's, down here to the 50-day and then one more rally. Silver still not acting as well, but above both support lines. So again, the metals are holding in there. That's all I can say about the metals at this exact moment. Maybe we get a final puke in the markets. They come down to all these supports, and then everything can rally together. Lastly is Bitcoin. Bitcoin, like the market, exactly. Remember, I told you Bitcoin's not going to do something different. If the S&P and NASDAQ are tanking, Bitcoin's tanking, and we're getting that. Okay, it kind of it did it a little earlier, but Bitcoin has had a big correction. Down from 110 to 80,000 here, a little below 78,000. Had a big bounce, but this doesn't look great. Okay, so I don't know if the S&P is really going to rip. Or do we need to come all the way down here to like 72,000 on Bitcoin and then get a bigger bounce? Even if that was to happen and we rip to the downside, here's the retracement back to where we are now, okay? Or 90, 91, or 96. So again, even if Bitcoin's going to come down here, we're probably going to come all the way back up here, and that would be a place maybe to lighten up. However, there's also a scenario where the bottom is in. It already is leading the S&P. The low is in, and we're going to see this one more rally into maybe May. There's that new high in the S&P, and they both go up together. So again, we need more information. The other scenario is this pink where we have this bounce here and then rip to the downside. That would match building the shoulder and ripping to the downside. So as you can see from all these things, there is still no definitive type action where we want to do anything right now. We need to wait again for a low to form. It looks like the market's bouncing off the lows a little bit right now. What do we get to? 5666. I wanted 5608 or 5615. So let's see how it goes. But as of right now, market's a little bit off the lows there by about 20 points or so. So we'll see how we go. But again, all in all, we're in decent shape, given the long-term picture of where this may go. We already have some cash, and now we're looking, should we really hunker on down, or is there a chance for one more high? And I showed you that information. We will not know the answer to that until we get a low, and not a one-day bounce. I mean a 1.5, a month and a half, 2-month bounce. This shoulder took about a month and a half. So if we find the low, we're looking at a month and a half kind of move to make the symmetry. That's the type of move we're looking for, okay? Not just a one-day situation. So I hope that cleared up things. Like I said, I feel like I have a great handle on things. We've been talking about this. It's here. But as I said last week, this part, it could be a little sloppy. as we get kind of like this tugging back and forth. Is this exactly it? Is it not it? And we need to kind of let things play out, and we just need a little patience to kind of see how things develop before we make any more aggressive moves. So that's all I got this week. Everybody enjoy your weekend, and we'll speak to you again next Friday. Take care. Bye-bye.